If I asked you right now what actually happens when you buy a share of Apple stock, where the money goes, who you're even buying it from, could you answer me? Most people can't. And that's not an insult. It's actually kind of insane when you think about it, because most of us have money sitting in the market right this second. A 401k, an IRA, maybe a brokerage app you check more than you'd like to admit. We're all passengers on this thing, and almost nobody knows how the engine works. My name is EcoSticker, and I spend way too much time thinking about money, the hidden psychological traps of wealth building, and why so many smart, capable people nod along in conversations about the market while secretly having no idea what any of it actually means. If you want to finally understand this thing you've been trusting with your future without ever really getting it, hit subscribe and give this video a thumbs up if it ends up saving you from nodding along blankly one more time. Here's the thing nobody tells you. The confusion isn't your fault. Financial media loves to talk about the market. Up, down, red day, green day, without ever explaining what the market actually is. It's like watching people discuss a sports playoff standings for years without ever explaining the rules of the game. You pick up fragments. You nod. You never actually learn it because admitting you don't understand something everyone else seems to get feels embarrassing. So the confusion just compounds quietly for years, while your money sits inside a system you've never actually looked at directly. And here's what makes it worse. The people explaining it to you often benefit from you staying confused. A confused investor is an investor who pays for advice they could have gotten for free, who panics at the wrong moment, who trusts a stranger's opinion over their own understanding because they never built any understanding to trust in the first place. Confusion isn't neutral. Somebody's profiting off it. Today we're fixing that. No jargon for the sake of jargon. No pretending this is more complicated than it needs to be. Just the actual mechanics explained the way they should have been explained the first time. What you're actually buying. Let's start at the very beginning. A company, let's say a coffee shop chain, wants to grow. Open more locations, hire more people, build more roasting facilities. That takes money, real money, more than the owner has sitting around. So the owner does something clever. Instead of borrowing all of it from a bank and owing interest on every dollar, they sell tiny slices of ownership in the company itself. Each slice is called a share. If the company has 1,000,000 shares total and you buy one, you now own 1/1,000,000th of that coffee shop chain. Not symbolically. Actually, you own a sliver of the buildings, the brand, the beans, the whole operation. This is the part that trips people up. Buying a stock isn't like buying a lottery ticket or placing a bet on a number going up. You're buying a literal piece of a real business. When that business does well, sells more coffee, opens more locations, makes more profit, your tiny sliver becomes more valuable because you own a piece of something more valuable. When the business does poorly, your sliver shrinks in value too because you own a piece of something worth less. It's genuinely that simple at its core. Everything else is just details layered on top. There's actually a second way owning a slice pays you, beyond the price going up. Some companies take a portion of their profits and just send it directly to shareholders in cash every few months. That's called a dividend. Not every company does it, but the ones that do are essentially saying, we made money, and as a part owner, here's your cut. You didn't have to sell anything or do anything. You just had to own the slice. Who you're actually buying from. Here's the part almost nobody can answer. When you tap buy on your trading app, who's actually on the other side of that transaction? You're probably picturing the company itself, selling you a piece of itself directly. That's almost never what's happening. In the vast majority of trades, you're buying from another person, another investor, who already owned that share and has decided to sell it. The company already sold its shares once, way back when it first went public in a process called an IPO. After that, shares just get traded between investors, over and over, forever. The company itself doesn't see a cent from your purchase. You're not funding the coffee shop chain directly. You're buying a piece of ownership from someone who already owned it and wants out, at whatever price the two of you agree on. This is why stock prices move constantly. Every second the market's open. It's not some invisible hand deciding a company is worth more or less by decree. It's millions of individual people and institutions, all deciding in real time what they think a share is worth, and trading based on that belief. The price is just the most recent point where a buyer and a seller agreed. Why prices actually move. So what makes someone willing to pay more today than yesterday? A few things, and they all boil down to expectations about the future. If a company announces incredible earnings, more investors want in because they expect that success to continue, and the price rises to reflect that new demand. If a company announces layoffs or missed targets, investors get nervous about the future, some decide to sell, and the price drops. But here's the part that genuinely surprises people. Stock prices aren't really reacting to how a company is doing right now. They're reacting to how investors expect it to do going forward. A company can report record profits and still watch its stock price fall because investors expected even more and got disappointed. A company can report a loss and watch its stock rise because investors expected an even bigger loss and got relieved. The market isn't grading the present. It's constantly betting on the future, and prices shift every time that collective bet changes. This is also why a piece of totally unrelated news, a change in interest rates, a headline about the economy overseas, can move a stock even when the company itself did absolutely nothing that day. The price isn't just about the coffee shop chain anymore. It's about how that headline might ripple into the coffee shop chain's future. Everything's connected, and the market is constantly trying to price in connections most of us never even think to make. The exchange, where all of this actually happens. You've heard the term stock exchange 1,000 times without necessarily knowing what it is. Picture a massive, highly regulated marketplace, historically a physical trading floor, now almost entirely digital, where all these millions of buy and sell orders get matched up in real time. The New York Stock Exchange, the NASDAQ, these aren't mysterious institutions. They're just the infrastructure, the actual technological plumbing that makes sure when you click buy, your order finds someone else's sell order almost instantly at a fair, transparent price, with rules in place to keep the whole system from being rigged. This is genuinely one of the most impressive parts of modern finance. Millions of trades worth trillions of dollars matched and settled every single day with a level of speed and reliability that most other systems in the world can't touch. What those index numbers actually mean. You've definitely heard someone say the S&P was up today and nodded like you knew what that meant. Here's what it actually is. Instead of tracking one single company, an index bundles together a group of companies, 500 of the largest in the case of the S&P 500, and tracks their combined average performance. When someone says the market was up 1% today, they usually just mean this bundled average rose 1%, not that every single company rose. Some went up, some went down, but on balance, the whole basket gained value. This matters because it's genuinely one of the simplest, most effective ways an ordinary person can invest. Instead of trying to guess which single coffee shop chain will succeed, you can buy a tiny slice of the entire basket at once, 500 companies in one purchase. You're not betting on one winner. You're betting on the aggregate success of the economy's biggest players, which historically has been a remarkably steady long-term bet. Why the whole thing grows over time. Here's the question that actually matters most for your money. If individual stock prices just bounce around based on shifting opinions, why does the overall market tend to go up over long periods of time? The answer is almost boringly simple. The economy grows. Companies innovate, populations expand, productivity improves, new markets open up. Slowly, unevenly, with plenty of painful dips along the way, human economic output tends to increase over decades. And since stocks represent ownership in that output, the total value of all those little ownership slices tends to rise right along with it. This is why owning a broad basket of stocks, instead of betting everything on one company, tends to work so well over long stretches of time. You're not betting on one coffee shop chain surviving forever. You're betting on human economic progress continuing, which, historically, has been one of the safer long-term bets a person can make. Why this actually matters for you. Understanding this isn't just trivia. It changes how you actually behave with your own money. When you understand that daily price swings are just millions of people constantly re-guessing the future, you stop panicking every time the market has a red day. When you understand that you're buying real ownership in real businesses, not a lottery number, you stop treating investing like gambling and start treating it like what it actually is. Patiently owning small pieces of things that tend to grow over time. Most people who lose money in the market don't lose it because the market failed them. They lose it because they panic sold during a dip they didn't understand, or chased a stock they didn't understand because they never actually learned what any of this meant in the first place. The confusion itself is the risk, not the market. So here's where you stand now. You know what a share actually is. Real ownership in a real business, sometimes paying you directly through dividends. You know who you're actually buying from, another investor, not the company itself. You know why prices move, shifting expectations about the future, not present performance. You know what an exchange actually does, matches millions of orders instantly and fairly. You know what those index numbers you've heard 1,000 times actually represent: a bundled average of hundreds of companies. And you know why the whole thing tends to grow over time. Because human economic output tends to grow over time, and you own a piece of it. That's not nothing. That's the actual foundation most people go their entire investing lives without ever building. You don't have to nod along anymore. You actually know how this thing works now, and that changes everything about how confidently you'll manage your own money from here forward.